Okay, thanks, Tom. So what I'm going to talk about today of those subjects is simulating carbon markets at Stanford. And so I'm the Associate Director at the Program on Energy and Sustainable Development over in Encina Hall. And I'm happy to talk more with anyone who's interested about some of the other things we do. So this is a great time to try to understand how cap and trade markets work and how to make them better. In my view, we're at an inflection point in global climate policy where there's been kind of a recognition that this top-down strategy of we're going to just get the whole world together, or at least the developed countries, and put them under a big umbrella and solve climate in one fell swoop, that's not working so well. There's a big carbon market in Europe, which has had some impact and been significant, but very little else on a global level has happened in the last 10 years. So what is very encouraging is that regional carbon policies have started to develop in recent years. And right now in particular, several carbon markets have been established recently. So California under AB 32, Quebec in Canada, actually British Columbia in Canada has established a carbon tax, and Australia and New Zealand are other examples. And then there are other places where carbon markets are close to being launched or very seriously being considered, including in important countries in Asia. China is now rolling out some pilot carbon trading programs for cities and smaller jurisdictions. So the good outcome here is that this becomes a bottom-up way of dealing with climate on a global basis, and so that these markets work well, and these markets start to become linked together. That's what we would like to have happen. But a bad outcome that's very possible is that there are some serious issues with how these carbon markets work that discourage other jurisdictions from putting them in. So that's why this is a particularly important time to look at these markets. The work I'm going to talk about here uses game-based simulation of cap and trade markets. So this is something that we started out in a class in the business school last year. And the appealing thing about using these games is that they can get at strategic behaviors that aren't easily amenable to study in theoretical models. And you'll see that from some of these results. So to summarize what we did, along with Frank Wolak, I teach a class who I believe you heard from earlier this week, and I think I saw him around in the audience. We teach a class on energy markets and policy in the business school. So the year before, we had done a simulation of California's wholesale electricity markets, where we have student teams bid into these markets and trying to maximize their return. And the thing that we added last year was a cap and trade system on top of this that was meant to simulate what California has. So we had tradable permits on a web platform that all through the course of this game, these teams would both bid into the wholesale electricity markets, but they would also be trading carbon to try to overall maximize the return. So the revenue that they got over the cost of what they originally paid for their generation portfolio at auction. So I'd like to just give a very brief explanation for people who aren't familiar with it of how wholesale electricity markets work and what adding a carbon price to those markets does. So this is a very stylized example of an offer curve that would be bid into a wholesale market. So if I own a unit, so let's say I have a big coal plant, I am deciding, okay, I'm going to bid in my capacity. So on the x-axis is the capacity of the unit in megawatts. And I'll say what price I'm willing to run my plant for. So this price is going to be at least the marginal cost of me running my plant. So I'm saying, well, any price above this, it's profitable for me to run this plant. So this is what I'm going to offer in. So the regulator takes all of these offers from the different units and constructs an aggregate supply curve like this. And so here you see stylized, okay, there's a coal baseload unit that's very cheap, a natural gas unit that's maybe a little more expensive because in this scenario, gas prices maybe are higher than coal. And then there could be a gas peaker, maybe a gas turbine that's a less efficient plant, and as a result it's more costly, but I'm going to run it if it's needed based on the demand, and so if the prices are higher than this. So the regulator constructs this supply curve and crosses it with the demand curve, which I've shown here is pretty inelastic, and then says, okay, well, based on this, I'm determining the electricity price, and then the quantity of generation that's going to be run. And so all of the plants that are on this side are run, and all of the ones that are on this side do not run in that particular time period. So that's how the market works. So what changes when you add a carbon price? Well, essentially, for plant operators, this is another cost. And this is a cost, if it's a carbon tax, it's a cost that's assessed directly to them based on their emissions. But it's the same if it's carbon allowances that you're trading. You have to buy sufficient carbon allowances to cover your emissions. So let's just take this case for some hypothetical carbon price. So coal is going to see the biggest cost increase because it's a high emitter. Gas, maybe its costs only increase half as much as coal. And then this gas peaker, even though the fuel is lower carbon than coal, these are inefficient plants, so that affects the greenhouse gas emission rate, so that's got a high cost. So what it means is my offer curve is going to look different with that carbon price. So here, based on just what I was showing in the last slide, I've constructed the new supply curve for electricity. And I take the same demand, and so you have a new price and a new quantity of generation that we're seeing with this carbon price. And so if you compare it to the old price and the old quantity, you'll notice a few things. One is that I've changed the merit order. So gas used to be more expensive than coal, and now it's less expensive. And so as a result, I'm actually, instead of losing a bit of gas generation here at the margin, I'm losing coal generation, so that's good for emissions. And then the other thing you'll see is that I've reduced demand because the price is now higher, so some of the people are no longer consuming. So that's how the carbon price is working. It's shifting the merit order towards lower emissions, and it's reducing electricity demand. So so now I'll consider what we did in our simulation. So these are the 7 portfolios that teams had in the game. And so you can see there was variation in the types of plants that they had. Many of the portfolios were only gas, but there were a few. So big coal had some significant coal emissions, coal plants. Old timers had some coal. And then fossil light had a very low emitting portfolio. So it had some natural gas, hydro, and nuclear. And you'll see on the right, so with each of these portfolios at auction, we gave a certain amount of free allowances that people could use for the cap and trade. And then this also shows, well, the expected emissions without any carbon market. This is what we would have expected these portfolios to emit. So the question is, well, which of these portfolios are going to like high carbon prices, and which of them are going to hate high carbon prices? Any thoughts? So So I'll answer. It's a bit of a trick question, which is maybe why you're all reticent. But what one would tend to think, right, is high carbon price is going to be comparatively better for the low emitting units, right? So this fossil light, whereas something like big coal is going to get hurt more by these high carbon prices. Well, the reason it's actually a trick question, and this was one interesting thing we found in the simulation, is everybody should like high carbon prices from a profitability perspective for these generators. So that's a really strange result. So this is, or it seems strange at first. So these are all of the 7 portfolios, and these charts are showing their variable profits from playing the game as a function of carbon price. So we simulated this, and we went up to very high carbon prices to stress the system. So this is $500 per ton of CO2. So what you see is, and so they're making money from 2 ways. One is from spot electricity sales. So these are these light wedges that you see in all these charts. And then the other is their initial permit allocations, which is this dark wedge. So one thing that this tells you right off is it shows how these free permit allocations are really free money that you're giving to the units. And moreover, the higher the carbon price, the bigger the face value of this money. So all of this dark gray is just their pure windfalls from the fact that 80% of the permits were originally allocated to them for free rather than being auctioned. And so you see the biggest wedge for the market participants that got the biggest allocation of permits. So one thing this tells you is we really don't want to give away these permits. I mean, auctioning is a much better strategy for allocating. But there's still something else. So even for the electricity sales part, so even if you leave aside these dark wedges, all of these portfolios, except for East Bay, are showing that they're more profitable with higher carbon prices. So why is that? Yeah, so everyone likes the high carbon prices except consumers. We saw very high electricity prices in this game. So this is not a happy real world. And in the real world, the politicians would have shut this down right away, but Frank and I liked seeing people squirm. So anyway, so this shows, well, you know, why are higher carbon prices benefiting the generators? And so I'm demonstrating this with the big coal portfolio. So I have two lines. This was a simulated offer curve if everybody bid their marginal cost with no carbon regulation, so $0 per ton of CO2. This high curve is with $500 per ton of CO2, so very high carbon price. Well, what happens to this portfolio between the cases? Well, as we saw, so one thing that happens is you shift the merit order. So Four Corners is really cheap to run in a no carbon regulation case. But with $500 per ton of CO2, it becomes very expensive. So now this is the unit right at the margin. So that's one thing that's changing. These units are natural gas units. So these are kind of near the lower priority in the no carbon regulation case, but they move up in priority when there's the high carbon price. So what's actually happening here is, yes, big coal is losing a few coal units, but because this pushes up the electricity price so much, this is the new electricity price with this high carbon price, the profits they're earning on their remaining units are more than outweighing the fact that they're losing a few coal units in this merit order. So this was kind of an interesting finding. So a few other things which I'll briefly talk about, that this simulation really revealed the challenges of cap and trade and some of the things that can go wrong with it and be inefficient about it. And I'll talk about a few. So one is that there was a lot of disagreement in our game about the correct carbon price. So what carbon price should teams factor in to run as profitably and efficiently as possible? And our trading platform, it was strictly bilateral. So there was no, all the information they would be getting would be just from the trades that they would be seeing. So it was very hard for teams to agree on what that carbon price should be. And so one thing that's always a challenge with these cap and trades is small mismatches in the number of permits and the demand that are available in the demand can make prices very volatile. If you have slightly more permits than you need, your price can go towards zero. If you have slightly less, it can go very, very high. So it's just built into cap and trade that it's hard to assess supply and demand. But also we'll see that our allowance market was very illiquid and was not very effective at providing information to teams about what the commonly accepted price of carbon was. And then moreover, we saw that carbon price wasn't always set by supply and demand. And I'll show this in a moment. There was market power exerted in the allowance market. So to start with, well, what should the carbon price have been? And so, I'm saying should, there's no real should in some sense, except that, what our goal is with this market is to reduce emissions as efficiently as possible. So this just shows, so in a theoretical sense, cap and trade and carbon tax should be able to accomplish much the same thing. This is where I did simulations where I just put in a carbon tax of different levels. And so what you can see is as you increase the carbon tax, you'll get more emissions reductions, both from this merit order change and also up in this part of the curve from shrinking demand. So one way you do it is you set, so this chart is saying, well, if I set a carbon tax of $260, it's predicted to reduce emissions about 10%. So what we did is we said, okay, well, we want to make this a stress system, so we're just going to set our cap about 10% less than the emissions that would be emitted under business as usual. And so we expected that, well, price should be, if this is all running efficiently, somewhere around $260. What did we actually see among what teams bid? And so this is, we kind of back calculated in a particular hour the implicit carbon prices that teams were building into their bids in this hour. And you saw that there was huge variation from teams that treated the implicit carbon price as close to zero, so they thought there would be plenty of permits in the system, to teams that were bidding that factored in carbon prices very close to the cap. So $500 per ton was the penalty that teams that were not covered by enough permits would have to pay. So huge variation. And what that did is that made the bid curve in the game very steep because of this variation in what people built in with carbon prices. So if you compare this against the bid curve for a tax that would have achieved the same emissions reductions as this bid curve, you saw that the game, it's resulting in much higher electricity prices and it's much less efficient at getting the emissions reductions. And moreover, the market did not help a lot in our game with providing information. And one of the reasons is that there were very few trades up until after the close of trading. So we had a true-up time, so all of the trading had to be completed by a few days after the last electricity market ran. And so there was a flurry of trading right before true-up as the teams tried to cover their emissions and avoid paying penalties. But through the great majority, the middle kind of several weeks of the game, there was no trading. So it was hard for people to know where this price should be. And another thing I'll point out is that our calculation showed, okay, well, an efficient price, it should be somewhere around $250, and most of these trades occurred at significantly higher prices. So why was that? Oh, and then, well, and so one of the answers was market power, so that prices were not always set based on supply and demand. They were also set by teams trying to become permit monopolists or monopsonists and exert market and withhold permits or withhold from buying to affect the price. So one interesting thing we saw here was one of the teams was very clever. They were actually one of the portfolios that was shortest on carbon permits, but lo and behold, 2 days before, they dumped all of the permits they had, and we were thinking, wow, I mean, what are they thinking? And in fact, they even asked us, well, are we allowed to sell permits we don't have? And we said, no, but we'll think about it for next year. So they dumped all these permits around $400, and they had realized that another team had all the permits to sell, so they set themselves up as the only significant buyer of permits. So there was kind of two people playing chicken with the other, and so this team figured correctly that they could buy them back at less, and so they essentially had a permit shorting strategy, which they turned a little profit on. And then the other big exercise of market power was at our initial permit auction for the 20% of the permits that were remaining. Team 12 essentially bought them all, which we thought was a bit crazy because they were buying it at a price that wasn't that much below the penalty fee for emitting without permits. But again, in light of what we realized about high carbon prices being desirable for this team, the strategy makes a bit more sense. So they essentially, by doing this, were able to create a carbon price expectation in the game far above what we thought the efficient carbon price would be. So this was quite, I mean, we hadn't really approached this initially as a research project, but it really impressed on us the value of this kind of game-based simulation. And so what we're doing now with the support of the Precourt Institute for Energy and the Tomcat Center for Sustainable Energy is we're working to expand this game-based simulation to a much bigger population at Stanford. And we want to test a bunch of interesting policy-relevant questions around cap and trade markets. One is, what happens when you link between markets in different jurisdictions, which is, for example, California and Quebec are going to link within a few years. Look at the interaction between carbon markets and renewable policies, like the Renewable Portfolio Standard. Test a number of different market rules that might have helped improve perhaps some of the dynamics that we saw in our game, like forcing information disclosure about trades, giving people position limits on how much they can hold. And then down the road, we're hoping that this is a tool that can be used by policymakers, regulators, and market participants to try to anticipate problems that they might observe in cap and trade, and so make these markets work better, and then help bring in, create broader buy-in to carbon markets in a number of jurisdictions. So thank you. I welcome any questions you have. Yeah.
One question about the way you determine price of electricity. Aren't utilities that own a wide portfolio of plants, aren't they restricted in the amount of profit they can make by law? Aren't they regulated in the amount of profit they are allowed to reap?
Well, so they're regulated in the return that they can get on things, right? But not on. So if they want to make some new investment, right? Their rates are set, and so they have to approach the regulator and say, well, here's our case for a rate increase, right? But as far as the wholesale prices and how those markets work, no. I mean, they can make a lot of money off of that, and in fact, often that is where a lot of the money gets made, is when prices are spiked in wholesale markets, because it gives them chances to exert market power and get more revenue off of that.
I was wondering how you factored, in your research, how you factored the carbon tax or the cap and trade price that the utilities have to pay into the energy prices and their profits. I was a little confused why with the carbon tax it would get higher profits.
Sure. Yeah. Well, let me go back to that slide, because it is a bit counterintuitive. So if you look here, these gray areas are the variable profits that they're making off of particular units, right? So essentially what they're earning from running a plant is going to be the difference between the price that they're getting, which is that wholesale electricity price, and the marginal cost that it is to run that plant, right? Times the capacity of that plant. So you can basically think of these areas are those are the variable profits that they're making from each of those units, right? So this one, for example, it's at the margin, so they're actually not making any variable profits for this unit, because the price and the cost are the same, and these units are not running, right? Because were bid in above the price. So these are really the profits. And the way, so it's pretty easy to think about a carbon tax and how that factors in, right? Because if I have a $50 per ton carbon tax, the way that'll factor into my cost is it'll just be the carbon tax times my emissions rate, right? So I have $50 per ton and a certain 0.9 tons per megawatt hour, right? So that gives me $1 per megawatt hour. So that carbon tax goes in there very straightforwardly, just as a cost, and ultimately it's the same for the allowances, because even if I even if I hold allowances to emit for all, to cover all of my emissions, it's still the opportunity cost for me of running is going to be equal to whatever I could sell that permit for, right? So even if I have allowances to cover all of my emissions, if I think that I can make more by selling those allowances than by running my plant, that's what I'll do. And so it ultimately, factors in the same way. So what's happening is it is increasing the cost, right? So of my unit, in this case, this was a case where the all the portfolios were bidding in marginal cost, right? So you see, these costs are much higher for this $500 per ton, but the price went up even more, right? Because the price is just set by whatever this marginal unit is, right? And so that's the dynamic that's making it more profitable. Yeah.
So if it just so happened that demand cost in flatter areas, then it might not necessarily be profitable. Is that mistaken? It's because the demand line
it's getting steeper. Yeah. So this supply curve. I mean, so one thing that one can also see for this is it would be much better if this demand curve were more elastic, right? Because if this demand curve looked more like this, right, then you wouldn't get nearly as much of an increase in electricity price because the consumers would be participating. They would be more readily reducing their demand instead of demanding the same supply.
Can you speak to the role of that high $500 a ton penalty in setting price expectations when you have not many market participants and not much information?
Yeah. Well, so one thing it does is it means there's no sense, presumably I mean, it should be a cap on the permit price, right? Because there's no reason to pay more than that for a permit when you can just emit and pay the $500 per ton penalty. And that was part of why it was counterintuitive to us to see a team bid so close to that cap for all those permits at the auction, because there was very little trading upside that they could get from those permits. There was only $30, kind of headroom, so they were taking a huge risk. But what helped us understand it more was realizing that they may have felt they could benefit purely by setting a price expectation that people would figure, because we didn't announce who won the permits at auction, but we did announce the price at the market clearing price for the auction. And so I think that at the very least their bid had a strong effect on price expectations. Yeah.
Okay, let's thank Mark again.